So the big question is this: how do investors like us, who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings and retirements, and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer. Hey guys, John Wooten here with the Stock Market Secret Podcast. I'm so excited today because Google is opening. Everyone is having an amazing day. The trading is tremendous, and right as the bell opens, we are going off to GT 1000 class, which is this tremendous class that every freshman has to take for summer school, where you get to learn how to write resumes and speak in public. So yeah, woohoo, right? Oh man. So anyway, something really interesting happened this morning in the paper. Now usually I'm not a big news guy. I'll just kind of chill out, not worry too much about media, because most of the time the only thing I care about is like this huge biomed report or a new patent or some super big pre-market catalyst that's going to have a huge impact on a 9 to noon stock and then cause it to go out there and explode, which is so amazing. It's so fun when they happen, and it's just great opportunities that'll occur when come up when there's huge pre-market news with a 9 to noon stock. But in more macroeconomic sense, this morning something kind of interesting happened with the G20. Right, you got Daddy Trump. He's in someplace, having a conference with these guys, trying to figure out what's up with global tariffs, which is super important because it kind of affects the entire economy, which by extent affects the stock market. So because of that, it kind of matters what happens. And one thing that I saw in the paper this morning, which is really crazy, was that the Senate or Congress in the U.S. right actually put a block on trade between Chinese corporations and U.S. corporations in the semiconductor field, specifically limiting transactions between supercomputer manufacturers, which is like, dude, usually I don't care, right? But like, what? Because you gotta remember, those computers are the basis behind blockchain, right? Because if you don't have the computers, you don't have the compute, then all of a sudden, everything stops, right? So having any sort of international tariff on computers indirectly affects the entire sphere of blockchain technologies, especially given Bitmain's preeminence in China. Now, there was a lot of really nice details about it, but it made me think a whole lot about international trade, especially in the technology space, when technologies sit at a fundamental backbone of blockchain financial markets, and how these tariffs that are coming across in so many industries now are actually significantly affecting the individual investor and their ability to manage money and have increased capital liquidity through blockchain technologies, which is so ridiculously crazy. So I see this article, and then I'm talking, and apparently one of my good friends, she put in a position with Google, right? And Google had done some crazy stuff in the last 2 days in response to that news. Also, because of some technicals, essentially what happened is they had this huge drop in the past week or two, and then after that, their stock bounced, hit a support level, and then started coming back up, and then just recently, it hit sort of like the 50 weekly moving average, 50 daily, and it's kind of trading back and forth. Google is a very big stock, not going to move particularly quickly generally, and it's also sort of one of the tougher ones to trade through technical analysis. So what happened in the last 2 days really shocked me because of that. They went down 8+% in just a couple days. And now usually it's not a huge deal, but then I saw this news and I was thinking a whole lot about whoa, people gotta chill out on the news, man, because the media affects so much mainstream investing, which is so crazy, because it literally impacts the way that tons of people how their portfolios perform in the marketplace, at least in any given function, in any given diversification. And that was really crazy, because these trade wars, the issues, the economic problems that are sprouting globally, no one really knows how long they're going to last, right? No one knows how the outcomes are going to create impact on the actual economic performance and the actual growth rate of these underlying tech companies, these underlying trading companies, firms. I know there's a whole bunch of news out in the petrol space, and then just recently OXY, which is a petrol producer, they went down into this flag setup, and you guys know flag setups from the book, where it goes down and then it consolidates and it goes down. And they actually just went through a flag setup. They were like $86. Then they went down $20 to $66. And then as the flag setup works, after the consolidation, you have another $20 to knock off the price range based off technical analysis. So the thing drops to $46 when it used to be like 86, which is ridiculous. And now I'm getting that hard on a call option, which I'm thinking in November will have some tremendous results in the marketplace, because right now they're just so low, and they're hitting the bottoms on these Bollinger Bands, and they have these just massive monthly red volume candles. So it made me realize that like news can suck if you already own the stock, but if you don't own the stock, it creates this insanely awesome ability and this opportunity to go into the marketplace and take the cash that's on the side and very selectively inject it into some of the best performing positions that are going to be around for the entire year. Because instead of being reactive and buying and selling or whatever based on the news or changes in the technicals or whatever, you're actually being proactive, and you're waiting for that setup. You're waiting for the perfect place to. Again, it doesn't have to be perfect, right? It's always super tough to time the top and the bottom. I know with OXY, they hit 46, which was the technical bottom, but then they kind of bounced a little bit. I was slow. I didn't figure out about it in time, and now they're at like $50, $51. Then the upside on a call like that just kind of depends on the moving averages. Low end $60, $64 in a couple of months. You take like a $2 down for a call on that, and then you're making $8 for every dollar that you risk, which is awesome. But again, options a little bit scary, a little bit. You gotta have more experience, because if you're wrong, then you lose everything, which is just how the game works. So it's really awesome, because you can find these awesome opportunities that are created when the media goes and says this stuff is terrible. But at the same time, you definitely have to be careful, because sometimes it'll stay down, right? I know last year, I think even in the stock lectures, I was talking about Newell Brands. And Newell Brands, they were absolutely crushing it. They were out there doing everything they could. I feel like they were at like $60, $70 plus dollars. And then they went down to like $20. And they were right at that 200 monthly moving average. So huge area of consolidation and a ginormous drop in the market. So because of that, I got in on them as a traditional buy. But what happened is they just kept sinking and all the way down to like $15. So got screwed a little bit on them in the short term, because they kept going out. And that's why I'm more grateful that was a normal position, because I'll be able to give it time and allow it to recover and grow in the long term. I also know in the short term, I could have just cut a loss, could have set a stop loss. It just depends on your vision of the company and how much capital you have to allocate to that long-term portfolio, especially as you make swing trades, which is interesting, because you definitely want, a lot of people, they take their gainers and they sell them super early. And that's what sucks for a lot of people, is they don't base their exits on technical analysis, just they base their entries on technical analysis. So you always have to be a little more mindful, a little more careful about that. I think a really great example of that is AMD, because AMD today, they were being talked about too with this whole deal with the microchips and the supercomputers, because they do a whole bunch of blockchain tech with their cards, their Vega cards, and their killer technology. But it's going to really affect them if a lot of these tariffs actually get passed on to them and impact them, which is why I'm glad that I sold a lot at like the highs based off technical analysis around $3. And the way you find those highs that I talk about in the book, I think I actually specifically use AMD as an example, because you can look at that long-term peaks, those long-term areas of price consolidation, and use them as a way to judge and predict exactly where those tops, those peaks are going to be in the current marketplace, which makes it a really, really powerful way to get out there and produce the results that you want. Because those results are going to come once you time them the right way. And you use that timing to go out there and crush it. It's so fun. But also you have to remember, right, with this new stuff and with principles, in the long term, the news today just isn't going to be a huge deal. You got to kind of chill out. That's why usually I don't watch the news when trading. It's just not it just doesn't affect, at least not in the noon stocks. It makes absolutely no difference because that's all technical analysis. And then with long-term investments, if it's really, really important, if it's something that really is affecting the company, like you're going to figure it out one way or another. And you don't have to go out and like search for it actively. Like it'll come to you. You can chill out, you can relax and have faith in the underlying companies and have a total conviction and belief that they're going to do what's best for the investors. They're going to do what's best for the long-term profitability of the company. That they know what's up. Like CEO of AMD, Lisa Su, she's insane. She's got like a PhD at MIT. She's like the tech girl, right? And she loves what she does. She goes out there, she crushes it. She creates these insane products, and she brings the value to the marketplace and gives people what they want. And like that's super cool for fundamentals, and that's why you take a trade like that or a swing trade like that, at least partially, on an understanding of the fundamental growth and the prospects of the company versus going all in. So like with Google, right, you understand that they make a whole bunch of money, basically all their money through advertising. But at the same time, right, why do these tariffs affect them? Well, if you've read 0 to 1 by Peter Thiel, which I do a book review on YouTube, in that book he talks about how Google tries to look like it's not a monopoly in the advertising space, in the search engine space, by selling phones, right? And they sell consumer electronics. And they say that they're under immense competition in those fields, even though a vast, vast, vast majority of their income and their profits come from marketing. They have these other areas of their business that they use to evade regulatory oversight, because they just don't want to be broken out and called a monopoly, since they sort of have a monopoly over the search engine market, and they have sort of like fake competition that makes them look like they're not. So because of that, does it really fundamentally affect Google's business if the tariffs on electronic goods from China to the US increase for the next couple months? I mean, the answer is no, right? It's going to have an impact on the technology producers, the manufacturers, the chip makers, supercomputer companies, like D-Brand, like D-Wave. Those are the companies that are more affected. But because Google has this public perception, right? That's what matters, right? That's what moves a stock, is their public perception. If people think Google makes phones, if people think Google's in the mobile business, the mobile industry, then they see stuff like this where it's going to hurt the mobile business, it's going to hurt the mobile industry, then they're going to think that Google will go down. The public perception says that, so the stock price follows until, like we talked about the other day, they eventually have their earnings report. They eventually, show the marketplace, hey, these are our results. We actually made a whole bunch of bank. Here are the billions of dollars we made. Our stock should go up a bunch, please, and thank you. And then, their stock goes to a couple $1,000 plus, right? And it's all because they produce those results. But in the short term, the news and the media and some speculators, right, especially with these bigger stocks that make up, a real hefty piece of the American economy, it's really just, a lot of scared people, a lot of emotional people investing. Then they freak out and they decide that stuff's going to crash, the world's going to end with whatever it is they're doing, instead of making slow, methodical, and quality decisions with their investments that lead to the best overall peak performance in the long term, because they understand the ups and downs, and they also are willing to go through. You gotta hustle through the stuff if stuff messes up, because you understand the long-term value and the long-term growth, the overall portfolio, and if something doesn't fit or the technicals don't look good, it's based more on facts and figures and indicators than what the news anchor says for the day, which is why it kind of sucks when a lot of people make these emotional decisions, because emotions just don't have a place in the market, especially in 9 to noon trading. These stocks are ridiculous. They'll do crazy things. I know people, and they've shorted a stock after it doubled or tripled, and then it goes out and it quadruples, it quintuples, and then it stays there for the rest of the day. Then they get a call from their broker at 2:30, and they say, hey, you got to cover this position. We can't float these shares overnight. And they get screwed, man. And it sucks because it's all based on facts and figures for those positions for 9 to noon trades. And you can't just have a lot of times an emotional feeling that, oh, this company obviously is not worth as much, because in all reality, the stocks are worth what people pay for them. And especially with 9 to noon stocks, people are going to change their perceptions of the value of a company extremely quickly. And if there's a very low number of shares in the marketplace, there's a very low float of tradable shares, and a very, very large percentage of that float, like 80+%, sometimes double the float, triple the float, you'll see stocks where the number of shares traded in a given day, as the stock goes up and up and up and up and up, the number of shares traded is like double or triple the actual number of tradable shares. And it's like, dude, that's when you know that these companies are getting bought and bought and bought and bought and sold and sold and sold and sold. But it's happening so much that people are like literally holding majorities of the company's tradable float, and they're using those as tools to the stock just keeps going up because there's nobody trying to sell, until through technical analysis individuals identify selling points, and then they collectively agree to sell at like a resistance level, or to sell at an ABCD setup, D end, a D top, the top of the technical setup, or maybe something like stochastics, right? And it doesn't happen, consciously. It's not something that people are just like, hey, let's all sell here, right? It's more like a market consensus of the individuals trading via technical analysis and using their skill set, a very, very specific skill set in that industry, that application of the market, that application of stock trading, for this one task of having a position that pays their rent for the rest of the month, of having a position that, lets them go out to dinner every day for the rest of the month, stuff like that, where it's a huge impact for these individuals, and they take it like a career, because for most of them, for at least a lot of them, I'm gonna go on your right, my man, I appreciate it, you're killer. For a lot of them, they're just unable to part with it, because that's what they do. That's what they love, and they use it as a tool to fund their lifestyle, fund whatever the heck they want to do. And when it works, like, that's just what they stick by, and they make it work. And that's why it's so powerful to have tools that work consistently through the trades, rather than waiting for news to pop, or waiting for somebody on the TV to say we should all go buy this stock. And usually that won't happen. Usually media's good about stopping people from just promoting stuff, which is awesome. But it's sort of like the same mentality with IPOs, right? You'll have these companies, and they'll go public, and it's huge for them, right? They're like, oh my gosh, we just raised hundreds of millions of dollars, billions of dollars, and we're finally able to sell our equity stakes in the market. And like, that's what I want you to focus on, right? Sell their equity stakes in the market. Private investors that have been investing in Uber, they're investing in Lyft, they've been investing in all these companies that are now going public. I mean, they've been in those for decades. And when they go public, a lot of those guys are going to go out there and dump their hundreds of thousands, millions of shares into the market to take some profits, right? If they 10x their money, and they're like, dude, I'm out of here, let's go. Because you always have to remember, with long-term investments, you might think you're getting the best deal in the world, but you always have to think about, there's people that bought this stock 10, 20, 30 years ago, and I might be looking at something like Advanced Micro, right? They're like $30 right now. I might be thinking, oh my God, if I could only get them at $25. But then, remember, there's also people that have these long-term portfolios that are invested in index funds, or maybe they've created their own portfolios, which is awesome. And they've had outperforming returns because they do their own management. They don't have to pay crap to people. It's awesome for them. Oh my gosh. You look at that, and those are the people that are like, yeah, man, I remember buying AMD at like $1, like $3, like $4. because that's what the stock is to them, and they have that psychological base level for what it's worth and how much they paid for it. When they see, $25, $30 in their mind, it's the difference between, 5 figures, 6 figures, or something like that, where they're actually able to scale themselves to an extent that's so much greater than what you're thinking about when you start a position, when you enter it. And that's why, when you're getting into a lot of positions, you got to remember that you're usually, especially like when I was starting, I was small fish, and it's a really, really big pond made of trillions and trillions of dollars. But you also remember there is a total and complete abundance of wealth in the marketplace. There's some Norfolk Southern, I see them a lot. If you guys like train stocks, oh man, they've been crushing it lately, doubled I think, which is awesome. Crazy economy right now, absolutely amazing. But anyway, you just like think about it to the extent that when you're starting, right? There are these companies, they've gone public, and a lot of times, why do they go public? Well, they go public to make money, right? The people that started the company want to make money. They want to cash in on their money. They want something else about money. They want funding. It all comes down to bank. And the really amazing thing about the stock market is that when these people that have gone out there and put in the work and put in the effort and gone so hard, taking out investors, going into debt to start these companies and creating these ridiculously powerful machines, these assets for corporations, once they go public, for as little as a couple pennies, a couple dollars, maybe like $10, $20, you're able to own like a piece of that. You can become part of their company. You can take ownership of part of their profits and become part of their team, right? As a metaphor, like you're an investor. So you can have just a little chunk of that huge company, and it's going to work for you, and it's going to work super hard for you because it's working. It's putting in, the company, the employees, managers, the directors, board of directors, whatever. Every single person there is working as much for the CEO as they are for you. And you can have, the only thing that's different from you and the CEO once you invest is either you don't get a salary from the company since you don't work there. But the biggest difference is, because most of the really big guys, they don't want salaries, right? They want stocks, because stocks and options, they have a tremendously better treatment under tax laws, and they're much easier to take wealth out of the company with, rather than a traditional paycheck where it's got to go through income tax. They might take something like a distribution where they pay lower dividend rates or other forms of walkarounds or workarounds where they're able to take less out of the company. So most of their pay comes through dividends, and those dividends are paid in accordance to the number of shares that they own, right? So if there's 1 million shares in a company and the CEO owns 40,000, for you to get paid about the same as that CEO, all you have to do is go out there and just buy 40,000 shares of the company. Maybe you don't want to buy 40,000 shares. Maybe that would unbalance your portfolio. So maybe you decide, hey, I'll just buy 400 shares. I'll own, a 100th of what the CEO owns. And now, when you get paid through those, long-term appreciation, those dividends, however it is that the stock increases in value, if you get bought out, you're going to get paid 1% of what the CEO is paid. So you're basically 1% of the CEO of a company. And what did you have to do to do that? Did you have to put in the 140-hour work weeks to get out there every single night and grind and go? No, you don't have to be in the marketplace every single day, putting the work in every single day, grinding every single day to the 150% max of your ability to go out there and create this asset, this company that's going to create wealth for millions, at least hundreds of thousands of people, right? It's just, all you do is just click the buy button on your broker, right? You don't have to go and take your car and drive to a building and say, maybe I would like some real estate here today to expand my company. Or you don't have to go to those strategic meetings and say, what are some new things that we can introduce into the marketplace to better satisfy our clients? You know, like if you buy Apple stock, you don't have to go to all those engineering meetings and help the people decide, you know, what shape the next iPhone should be, or what color this new product should come in, right? It's just not even part of what you do, because an investor, you just front up your cash and say, hey, look, I'm going to give you this money, and it's going to show you that I am of value to the marketplace. And then they see that and they say, oh, okay. Looks good. You are of value to the marketplace because you have this money and you have now exchanged it for part of our company. And now, as we work every single day to grow our company, to grow our profits, to grow our revenues, for the sole purpose of benefiting the business owner, for the sole purpose of growing our employment base for the benefit of the business owner. You know, a lot of people say, like, what's the point of the company? At a fundamental level, right, they're trying to make money for the business owner. So when they work towards that goal, the business owner, once they go public, is nothing more than a shareholder just like you. So when they work to benefit the business owner, they're working to benefit the shareholders. When you buy their stock, these people are literally going to work every single day. They get paid every 2 weeks because they are there to provide value for the business owner. They're there to provide value for the shareholders, and they're there to make you money. I mean, isn't that awesome? Isn't that cool? Like, you own just a very, very small part, but still a significant chunk of the reason that these people are employed in their jobs, in their work. And it all comes down to like, you have the capital at first, and so instead of going out and blowing it on a new pair of shoes or some new pants or whatever you can find at the mall, you take your wallet and you say, you know what, I'm going to leave this at home today. I'm going to save that cash, save whatever, save use of the credit card, and then you go home at the end of the week or the end of the month or whatever, and you put it, you deposit it in the bank, or you leave it in the bank if it's already in the bank, and you just transfer it over to an investment account, transfer it over to your broker, and say, hey, look, I want to make an investment in my future today. I want to buy an asset that's going to serve me, it's going to work for me, it's going to grind for me every single day for decades and decades and decades, as long as this company is here. I want to put in a reasonable position in this, diversified portfolio. It's really, really, really crazy, powerful stuff. Oh, man. And diversification. Oh, my gosh. So I was listening to that Grant Cardone sales training the other day, which was awesome, cool stuff. I'll probably, like I said, do a review on it on YouTube. But he talks about, personal finance. It's just a very, very little bit. Most of it is, marketing. And anyway, so it's really great stuff. I just got to finish it, and I'll have it out there for you guys. He talks about diversification, and like with Warren Buffett or Ford, or a lot of these really, really prolific, innovators, entrepreneurs, inventors. They always talk, and he's saying what they do is they take everything that they have, and they put all their eggs in one basket, and then they really, really watch that basket and make sure it works. And look, for active management, where you have direct control over your profits and losses, specifically in 9 Indian stock, like, that's one way to do it. It's really, really risky, because with financial markets, you don't have that 100% certainty, that 100,000% control over anything. So, like, I use this example because it's so powerful. Like, think about, if you were an employee at Enron and you believed in Enron so much, and you put 100% of everything you earned into Enron stock that you could save and invest and grow your wealth, because you have that income and you're able to, take 40% of what you make and put that into an asset that will pay you for the rest of your life. You think in a retirement fund or whatever, for a savings goal. For those of you who don't know, a little bit newer, there's a whole movie about it. Like, Enron had this massive accounting fraud that nobody knew about except for like the guy who owned Enron. And in a span, they were like the biggest growing, most innovative, most amazing company in the whole world. Everyone freaking loved them. But then this scandal comes out, and apparently the guy, the whole company had been lying about everything they'd done. They were using a form of accounting where they would say they made hundreds of millions, billions of dollars, when in reality all they did was think about creating a deal and then sort of go a little bit into the deal, and then they wouldn't really actually make any money for months and months and months and months if the deal went through at all, which it oftentimes didn't. So they had all these fake profits, but they looked really, really good on the paper. They looked really, really good on financial reports. And what happened is there were a ton of financial advisors that controlled the wealth and the money and the capital of hundreds of thousands of people. And they all went and said, oh, we got to go buy Enron stock. Enron's the fastest growing company ever. They're the best thing in the whole world. And usually, if a lot of people think that you should buy a stock, a lot of people think you should sell a stock, they're probably wrong for very, very fundamental psychological reasons. And I talk about that more 9 to noon because it's kind of an important concept. Man, it can make you a lot of money if you understand it and apply it. So what happened, so they had this big accounting scandal. And then what actually happened, right now there's a big five accounting firms. It was actually used to be big six, right? So there were these 6 huge accounting firms that would take care of all these public companies and manage their financials. And what happened is on the day when SEC started to seriously push and investigate these guys, this accounting firm, they took every single document, all the receipts, all the papers, all the tax returns, all the audits, everything from Enron, and they were putting them in these massive industrial shredders, shredding tons and tons and tons of paper all at once to get rid of the evidence that there was actually this huge financial fraud, and they were lying about all the money they were making for the marketplace, which, you lie about the money you make, and then, if you look at the financials tab in Yahoo Finance, or if you look at an annual report from a company on their investor relations website, that's going to tell you, how much money they make. And essentially what they were doing is they were just flat out lying and saying, we made this much money, when in reality they made 1/100th of that. And there was this huge break crackdown with the SEC. They came in, and then this accounting firm shreds every single thing they have on the company, and all of a sudden all the evidence is magically disappeared. And then they realize that there's no money in the bank accounts of Enron. They're 5 minutes away from going bankrupt, and everything comes crashing down and crashing down and crashing down. The SEC comes in, everyone comes in, the regulatory agencies come in, and they're like, dude, this company's going bankrupt. How is this happening? And what happened is the hundreds of thousands of people that owned Enron stock were freaking out. The stock was crashing so much because just the week before there was a huge meeting, and everyone at Enron is talking about how they're this amazingly profitable company and how this awesome growth is gonna, forge their future, and they're all gonna be insanely successful. But what happened was so crazy because the company goes, and they had doubled and tripled and quadrupled over the past 2, 3, 4 years. They were everyone's this is the best stock in the entire world. And it was ridiculous. The growth rate, the metrics, the financials, everything was insane. It was so out of whack. And it turned out it was really just too good to be true. The company went ahead, and everything comes down, and it turns out they have no money in the bank. They don't have any assets. And what they were doing was actually manipulating markets. So they were in the energy sector, right? And there were these things called futures contracts. If you guys have read the book, futures contracts are contracts that allow you to buy, commodities, currencies, other assets, other financial securities in the future, right? So you sign a contract, you say in 6 months, I'll buy this, corn at, $1 a pound or something, depending on the current prices and where you think the prices are going to go. So what they were doing is they were selling futures contracts for natural gas, and they would say, this is what we think the price of natural gas will be, and that's what we'll do. And what they had is they would have this entire floor of traders, hundreds, I think, of traders that would go, and they would day trade the futures for natural gas every single day. And, ordinarily that's not a problem, right? Who cares? But because Enron was this ridiculously huge player in the natural gas space and in so many other areas where they did this, they would go and they would call their plants, like in California, and they would say, hey, you know what? Shut off the natural gas. We're gonna drive up these prices. So they would literally turn off the gas supply for like the entire state of California, and prices would like instantly quadruple. And so what they would do is they would go and they would sell all of their contracts at these huge, ridiculous, massive profits. Because if you guys know, in the futures market, you can have tremendous profits by using leverage, right? So they would take out debt and invest in these contracts, and then they would manipulate the underlying market so that the price would rise a whole bunch, and then they would multiply their profits geometrically because they use debt to finance their position on margin, which is extraordinarily risky. On your left, I really appreciate it, man. Thank you. And then they would do that, and then what would happen was insane. These guys would go out there and make like hundreds and hundreds of millions of dollars in a day just by manipulating financial markets. And then like the very next day, they would spend all the money to facilitate their operations as an entire global company in the energy sector. It was just insane. It was ridiculous. I'm almost out of time here. I have to go to school, which is a shame. But what happened is people came in and they realized, dude, this is seriously a problem. And there's a movie on this if you're interested in learning more about it. It's called Enron, The Ones on the Inside, something like that. Just Google Enron movie. It's really, really good. Learning a lot about the underlying fundamentals of a financial position. And maybe it was the guys on the inside, something like that. Because it was basically, they were inciting, they were just manipulating the stock market, manipulating a lot of things they didn't, lying about their financials. So the SEC comes in and they say, look, we know what you're doing, we're here to stop it. And the entire company goes bankrupt in the span of like a week or two. And every single investor loses. Because like the stock goes from $300 to $0 almost instantaneously. It was just ridiculous because anybody that had all of their money in Enron, I mean, they lost everything. It was all gone, nothing left. And that's why with long-term portfolios, it's really, really risky to go all in on something and go 100% your eggs in one basket. Because stuff like that happens, and it's happened to so many people, and they just have all their money in one stock, and then it crashes and everything goes down, and there goes their retirement. What are you gonna do? I guess that sucks. And it's just not even like, it's just such an understatement, because now you have people, and they were working their entire lives to be at Enron, and they put all their money in these stock ownership plans because everyone at the company was pumping up the stock, right? They were like, every single person there was constantly saying Enron stock is the best and everyone should buy Enron stock. So that's what people did. And they lost so much. Their entire retirements, their savings, everything disappeared. Just like that. Just like that. And it was ridiculous. Because now they're out there. They have to work as like postal service workers. They have to, they're like 90, 80, 70 years old. They have no savings. They have no retirement. All of their wealth was just washed away. I mean, absolutely ridiculous financial situation because these guys didn't diversify. So please don't be like that. Please be smart. Please make bank and go out there and crush it. Thank you guys so much. Have an amazing day. Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover completely for free at 9tonoonsecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.